Today, we're looking at an analytical report on SoundHound AI's really outstanding Q3 2025 performance.
It's certainly that. We're seeing record revenue at $42 million, a raised guidance, and, of course, that massive cumulative bookings backlog now topping $1 billion.
Exactly. So, look, this is a very compelling, fact-filled analysis, no doubt about it. But we need to make sure the presentation really matches the rigor of the data. So let's jump straight into the tone and the scope. The persuasive intensity of the language here, it sometimes overshadows the balanced analysis that you'd really need for a robust investment report.
I agree. You see the title, SoundHound AI Explodes, and phrases like monster Q3 report, massive squeeze. It definitely conveys the author's excitement about what they're seeing.
And the excitement is understandable. The numbers are hitting an inflection point. The problem, though, is one of credibility in this kind of context, right?
It is. When an analysis uses that kind of highly charged promotional language, it can risk appearing biased rather than purely analytical. It almost primes a sophisticated reader to immediately start looking for the counterargument.
And unfortunately, they won't have to look very hard to find what's missing. That's the critical weakness we saw. For all the bullish framing, the report completely lacks a dedicated section on potential risks.
Not a word on it. No competitive disadvantages, no counterarguments, nothing.
And when you're making a case for exponential growth, ignoring the downside isn't just unconvincing, it feels like an omission of due diligence.
Absolutely. If a report is telling me that enterprise adoption is speeding up and execution is on point, my very next question is, okay, so what could stop this? By focusing only on the upside, the analysis just fails to provide that objective risk assessment that investors rely on.
So the core suggestion for improvement here is kind of twofold. First, maybe temper some of the most emotive language to align the tone a bit more with professional financial analysis.
And second, and I think this is the crucial part, introduce a mandatory section that's dedicated to that objective risk assessment.
Right, you can still confidently present the bullish case, but you have to acknowledge the potential paths to underperformance. It actually makes the argument stronger.
And you absolutely have to address the competition, especially in these new markets. The report details SoundHound moving into healthcare and finance through the Amelia Factor acquisition. Those are not empty spaces.
Not at all. They're highly contested. So what's the risk that, a Google or an Amazon with their massive resources just decides to offer subsidized voice AI to enterprise clients? How do you compete with that? The analysis needs to show that SoundHound's specific tech provides a durable moat against that kind of pressure. So by building in that counter-analysis, the report just elevates itself immediately. It goes from exciting news into really robust investment analysis.
I think that's an essential shift for the whole piece. And speaking of rigor, let's move on to the financial centerpiece of this Q3 report.
Okay, let's transition to the biggest figure here, that $1 billion cumulative bookings backlog. Now, it's highly encouraging, a major sign that the company is converting hype into actual future cash flow. But its presentation needs, I think, a much deeper analytical context.
It's a phenomenal headline, isn't it? $1 billion. It perfectly supports that narrative of expansion and dominance. But for a serious investor report, just calling it locked-in future revenue is, it's just not enough detail. It raises more questions than it answers for anyone trying to really model this out.
So what are the specific details you feel are missing that kind of dilute the figure's impact?
It's two things, really. The recognition timeline and the contractual quality. We're left wondering, is this revenue going to be recognized quickly, or is it spread really thinly over, say, 7 or 10 years?
Which completely changes the short to medium-term picture.
Completely. Without clarity on that timeline, the true growth runway is it's obscured.
So the argument is that we need to elaborate on the composition of the backlog, to turn it from, a powerful headline into a detailed, actionable indicator of financial health.
Precisely. You have to ground that massive figure in the current financial calendar. So if the full year guidance is, 165 to 180 million, the report should try to explain what percentage of that billion-dollar backlog is likely to convert into actual revenue in the next 12 to 24 months.
That one addition immediately grounds the entire claim and gives the reader a way to track execution.
Exactly. And beyond the timing, there's the quality. Not all backlog revenue is created equal, right? The report should differentiate what proportion comes from these long-term, high-quality recurring streams, things like the Stellantis licenses or the multi-year Amelia subscriptions, versus, say, shorter-term deployment or one-off integration fees.
I see.
because the short-term integration revenue is more of a one-off bump, whereas the recurring license revenue shows stickiness and predictable growth.
Yes, and detailing that distinction is how you prove that SoundHound's growth isn't just fast, it's durable, it's high quality. It shows the company is building a fortress of predictable cash flow, not just relying on upfront fees.
That deep dive on the backlog's composition is absolutely essential. It turns a staggering number into a strategic roadmap. And that actually brings us neatly to the final area for improvement, which is all about causality. The section on massive expansion is great. It's comprehensive. It details all the strategic drivers.
The Amelia Factor acquisition, the Stellantis partnership going live in Europe, the big restaurant deployments, it sets the scene perfectly.
It does, but the analysis lacks a clear, quantified link between these impressive strategic moves and the actual Q3 financial results.
Right? So we have the inputs on one side, the acquisitions, the partnerships, and we have the outcomes on the other. 68% year-over-year growth, $42 million in revenue.
But the report doesn't explicitly connect which strategic move drove which percentage of that growth. The connection between the explosion and the massive expansion is, well, it's just generalized.
Is that link fully established? I'd argue it's not analytically. The reader is left to assume the impact, rather than having it proven to them. We need to integrate some kind of segment-level or attributed growth data to make this narrative airtight.
And this means using those strategic drivers to explain the rapid improvement in adjusted EBITDA margins, too. It's not enough to just state that management says margins are improving. We need to show the why.
Let's make that connection tangible. If 68% year-over-year growth is the key metric, the analysis should try to estimate how much of that acceleration is from Amelia's new higher margin revenue versus, the organic growth in the core automotive and restaurant segments.
That level of specificity would be huge. It transforms the report from a summary of positive events into a real analytical assessment of the company's recent strategy.
You're essentially providing the ROI analysis for the Amelia acquisition right there. And when you talk about the path to profitability, you have to connect the dots directly. Explain how that path is being scaled by the high-margin nature of these new recurring revenue streams. That provides a deep understanding of why the acceleration is happening. It's not just about size, it's about the quality of the margin.
And answering that margin quality question is what really sets a great analysis apart. It shows that the expansion isn't just for market share, but for profitable market share.
And if those quantified links are established, the whole argument becomes far more compelling and, frankly, more resilient against market skepticism.
So to recap, this is a very strong, fact-filled report. It makes a powerful case for SoundHound AI's current trajectory, and it's grounded in some really impressive numbers.
Absolutely. To maximize its impact, though, and to elevate it from a bullish summary to a robust analytical document, we've identified 3 crucial areas to address.
First, it's about balancing that highly enthusiastic tone. The best way to do that is by introducing a structured, objective risk assessment section. You have to tackle the competitive threats from the tech giants and the execution risk in that big backlog.
Second, provide that deeper analytical detail on the $1 billion backlog. We need clarity on the revenue recognition timeline and the quality of those contracts. Differentiate between the long-term recurring licenses and the short-term fees.
And finally, clearly quantify how the massive strategic expansions, Amelia Stellantis, translate directly into that reported 68% revenue growth and the improving margins. Make that link between strategy and finance